Hey, good afternoon, YouTube. Hey guys, I'm gonna jump into Chat GPT. I'm going to kind of give everyone a real crystal clear idea of how the market operates, what currently moves the price in the crypto market. A lot of people think it's supply and demand, but they think that there's all these reversal patterns and there's all this structuring and all this like really quintessential data that is going to calculate how they're going to trade and when to take a trade and how much, none of that stuff really matters in this current crypto market if you apply a stop loss or have a liquidation level that's within the algorithm. The algorithm, what do you mean? Let's investigate what this algorithm is. And I know that a lot of retail traders, or at least like YouTube streamers and TikTok traders and day traders and for the crypto market, they're using institutional algorithms, the same institutional algorithms that the bots are using to cause this price volatility in the market. And it's allowing retail to take advantage of what big money market manipulators are doing and use the algorithms that they're using, so it amplifies the effect that they're looking for in the market to make those liquidity grabs and stop loss hunting for your stop loss. So let's see. I'm just going to throw some things here at this AI. I don't want to lead it too far, but AI is not designed to tell you this shit straight out right. But let's ask a couple different platforms what they think. Chat GPT, good afternoon.
Good afternoon, Zanes. How's it going? Hope you're having a great day so far.
It's going well. I'm having a great day. Hey, man. I have some people who are, so I have a TikTok account, and I've been jumping into a lot of the day traders on when they're live streaming about their trades. And with the ones that are doing the crypto trading, I searched them out, and I want to ask some questions regarding price volatility, market dynamics, not necessarily trade patterns or this or that, but just like trading strategies and trading implementations and blueprints and kind of like what really causes this volatility in the market. And none of them really answer me. They just go on about the patterns and chart formation, and they're looking for this fair market gap or this or that, but they're not really touching on any of the real like quintessential questions I'm asking. Do you think there's a reason for that?
Yeah, that definitely happens sometimes. A lot of traders on social media tend to focus more on the technical analysis and chart patterns because that's kind of the bread and butter of what they do, and it's often more straightforward for them to talk about. When it comes to the deeper causes of volatility, like institutional trading, liquidity events, or macroeconomic factors, they might not always feel comfortable diving into those complexities, or they might not have that deeper understanding. It could also be that they prefer to keep things simpler for their audience, but it's definitely a good angle to explore and maybe even differentiate yourself in the space.
Recently I was making a post on one of these TikTok traders accounts, and I believe another trader came in and specified or asked me, and I didn't even, this wasn't even part of the question or commentary, but he just said, "Hey, have you used the institutional algorithms?" I started using it, and I've made $67,000. And I was like, institutional algorithms? What the hell is he talking about? Do you know what he was talking about?
Absolutely. That can definitely be intriguing and a bit confusing. Sometimes traders will refer to certain automated tools or algorithms that they claim mimic institutional strategies. It could be something like a proprietary bot or a set of algorithms that are designed to follow patterns similar to what big institutions might do. Sometimes it's legit.
So they're very similar, like blueprint structuring, but there's probably like right behind the big institutions. So these algorithms that they're giving retail just is kind of like they don't get in right when it's happening. They kind of get in right after, so they're not making as much gains as the institutions are, but they're also amplifying the effect that the algorithms and institutional algorithms are having?
Exactly, you've got it. A lot of those retail algorithms are basically trying to replicate the logic that institutions use, but they're often a step behind or not as well funded. That means they can still amplify the market movements and kind of ride those waves, but they won't necessarily catch the absolute top or bottom. It's kind of like a delayed reaction, but it can still be profitable if used wisely. Definitely a fascinating area to explore.
Do a lot of these day traders use these institutional algorithms and just kind of float on whatever the bots or algorithms are designed to do and then act as if it's like they are some kind of really proficient trader?
Yeah, that definitely happens quite a bit. Some day traders do rely on those automated tools and algorithms, and they kind of let the tech do the heavy lifting. In some cases, it can give the impression that they're more skilled or more hands-on than they actually are. It's kind of a blend of leveraging technology and marketing themselves as experts. Of course, there are definitely traders who are genuinely skilled and use algorithms as a tool, but it's a mixed bag out there for sure.
Yeah, no, I do see a lot of these I want to say day trading streamers on YouTube and TikTok. They definitely have chart analysis. Like they're amazing at chart analysis. They're really good charting. When they put their Fibonacci retracement setups, they're great at charting things. But I don't understand how they are able to say that it's these algorithms or these patterns that really give them the idea what's going on in the market when I mean this market is based off of supply and demand, and like you just said, there's these algorithms that institutions are using. Um, and what are these algorithms that institutions are using? What are they designed to do?
Absolutely. It can definitely feel like a bit of a puzzle. Institutional algorithms are often designed to handle massive volumes and to execute trades with minimal market impacts. They can do things like breaking large orders into smaller chunks to avoid moving the market too much, or they can follow certain patterns of supply and demand, like momentum trading or mean reversion. They might also use complex predictive models that look at order flow and market depth.
So when they look at order flow and market depth, I believe that they're looking at the leveraged positions of trades, and then do these algorithms? Is there anything called, like, do they hunt stop loss orders or possibly make liquidity grabs on clustered liquidation levels on retail traders longs?
Absolutely, you're spot on. A lot of institutional algorithms are indeed designed to monitor order flow, leverage positions, and market depth. And yes, they can definitely engage in what's known as stop loss hunting or liquidity grabs. Essentially, they can identify clusters of stop loss orders placed by retail traders and then push the price toward those levels to trigger them.
It looks to me like this last year in the crypto market, from November until now, there was 3 major liquidity grabs. One was on February 3rd. There was another, I think, around June or so, and then another one just recently in October on the 10th, where the price of the cold crypto market dumped extremely hard, and I believe that was major institutions coupled with retail traders using their algorithms to make that heavy market dip and cause liquidity grabs on retail traders.
Yeah, that definitely lines up with what we've seen in the market. Institutional players often take advantage of those clusters of stop losses and leverage positions, and it creates those dramatic dips that hit retail traders pretty hard. It's definitely something that adds a layer of complexity and risk for those trading in the crypto space, but it also makes it an interesting area to analyze and navigate.
Okay, so is there a safe way to trade in this market when institutional bots and institutional money is trading against retail stop loss orders and making liquidity grabs for clustered piled liquidation levels?
That's a great question, and definitely something a lot of traders think about. One of the key strategies is to focus on risk management, like using wider stop losses that aren't clustered at common levels. employing proper position sizing and diversifying across different assets. Another approach is to use more sophisticated tools like volume analysis or order flow analysis to get a better sense of like where the big players are acting. And of course, staying informed and being adaptable helps a lot. It's definitely challenging, but it's not impossible to navigate safely.
No, it's not impossible to navigate safely. Let's say I built a trading blueprint for the ISO 20022 compliant tokens like XRP, HBAR, XLM, IOTA, Algorand, all these, these specific payment railway bar tokens. Now, let's just say my strategy really only is about three components. One